Hello everyone, this is Patrick from AllQuant. So in this continuation of our Getting to Know Asset Class series, let's take a closer look at commodities as an asset class. But before I proceed, I would appreciate if you can help smash the like button. It would go a long way to help our channel. So these are the topics that I will be covering today. First, I'll explain what are commodities. Then we'll understand what is the difference between physical and financial commodities. We'll then take a look at the benefits of adding commodities to an investment portfolio. We'll also look at the inherent risk of commodities. Finally, I will share how to buy commodities as an investor. Let's start off by looking at what exactly are commodities. In many ways, commodities have to do with the real economy, because it involves the entire supply chain of maintaining our human way of life. The supply chain starts at the very beginning of extracting raw materials from underneath the surface of the earth. Raw materials can be iron ore, crude oil deposits, etc. It can also begin with the growing and cultivation of raw food such as cattle, wheat, grains, and so on. The raw materials are then sent on to refining or processing plants where they become standardized commodities with certain grading. They are then sent to warehouses or storage silos to be stored until they are bought by someone. They will then be shipped off to countries around the world wherever the demand is. Once imported, the commodities are further refined or packaged before they are sold as end products to the end retail consumers. So as you can see, the entire process from beginning to the end can be complex and can take some time. Okay, so this is the unique nature of commodities as an asset class. Broadly speaking, there are three categories of commodities. The first category is energy. This is where crude oil, natural gas, and other forms of energy-related commodities belong. The second category are metals. This group is further broken down into precious metals like gold and silver, and industrial metals like copper, palladium, and so on. The final group is the agricultural or soft commodities. This is where the food-related commodities belong to. Examples are cattle, hog, wheat, corn, soybean, coffee, and so on. Commodity trading can be broken down into two types. The first is physical and the second is financial. Physical commodity trading facilitates the exchange of raw physical materials between producers and companies in the real economy. Producers will deliver the raw materials to companies who need them as inputs for their respective businesses. The companies will then pay the producers a certain price for the raw materials. As we have seen earlier, there can be a long lag time between the company ordering the raw materials to the actual receipt of the goods. In the meantime, the price of the good can fluctuate quite a fair bit due to any number of reasons. It can be weather related or it can be related to the economic cycle. This is where financial commodity trading come in to help. Futures exchanges step in as the middleman to help both producers and companies lock in the prices that they want for the relevant commodities. When the producers receive an order, they can look at the current price of the futures contract that matches the expected delivery date. If they are happy with the price, they can enter into a contract to sell the amount of the order size with the exchange. In this way, the producers have locked in the sell price. On the other side, companies can also look at the futures contract prices when they place an order. If they are happy with the price of the contract that matches the expected delivery date, they can also enter into a contract to buy the amount of their order size with the exchange, thereby locking in their purchase price. In this manner, both producers and the companies are able to offset any gains or losses from the price fluctuation of the physical commodity with the futures contract that they have entered into. Now, if there were only physical players in the financial futures market, the futures market would not be liquid enough to be efficient. This is where speculators come in to add liquidity. Speculators are not in the market for hedging purposes. They are there to bet on commodity price movement in the hope of making money. Speculators do not hold on to the futures contract for physical delivery. They always close out their positions before the deadline for physical delivery. Now that you understand why commodity trading exists, let's look at the benefits of adding commodities to an investment portfolio. Commodity prices feed into inflation because they drive up prices across the entire supply chain. Hence, commodities are a good asset to own during periods of high inflation. Not so much because they benefit from inflation, but more because they are the cause of it. Since the beginning of this year, every other asset class is down. The only asset class that is up significantly is commodities. Therefore, owning some commodities in your portfolio would be able to offset some of the losses in the other asset classes. Another benefit of owning commodities is that it acts as a good diversifier in the portfolio. DBC is an ETF representing a broad basket of commodities. What we have here is a chart of the rolling 60 days correlation between DBC and two other ETFs. SPY is the S&P 500 ETF and IEF is the 7 to 10 year US Treasury ETF. You can see from the blue line that DBC can have periods where it is negatively correlated to SPY. And when it comes to IEF, which is the orange line, the correlation is negative most of the time. Hence, adding commodities should be able to lower the overall portfolio risk. Every asset class has its own weaknesses. So let's look at some of the risk of commodities. Commodities are volatile in nature. They can be sensitive to abrupt weather changes. They are also sensitive to the economic cycles and geopolitics as well. Commodities are not interest-bearing, neither do they generate dividends. It also costs money to keep them in storage. Soft commodities are perishables as well. As a result, holding commodities tend to be a money-losing proposition. As mentioned earlier, abrupt weather changes can lead to sharp changes in price, especially for crop-related commodities. Commodities can go through long periods of drawdown, which can last for many years. So this can be a painful proposition for a buy and hold position. This is a typical shape of the futures term structure of a commodity. The price of a longer dated futures contract tends to be higher than a near-term contract. This is because of the carrying cost of storing a commodity. So commodities tend to lose value over time. Think of it this way. Instead of buying the physical commodity and pay money to hold it in storage, you are indirectly paying for the storage through the decay of the futures price over time. The CRB index is a broad-based commodities price index. You can see from this long-term price chart that the CRB index suffered from a lost decade since the Great Financial Crisis in 2008. It only started to bounce back strongly since 2020. So do be aware that commodities can lose value for a very long period of time. This is also related to the carrying cost of commodities. Finally, how can one go about adding commodities to an investment portfolio? Well, you can open up a margin account with a broker and trade commodity futures directly. But before you do so, make sure you're familiar with how futures work and also look into the details of the individual contract itself. With the development in the ETF market, there are now several ETFs that gives you exposure to commodities. There are ETFs that give broad-based exposure, and there are also ETFs that track single commodities. You can buy these commodities just like how you buy a stock. However, do look at the prospectus of the ETF to understand how it works. you can refer to the link below for a complete list of the commodity ETFs. Okay, just a final word. Most of the single commodity ETFs are actually not very liquid. Okay, so do look at whether the trading cost due to the lack of liquidity is something that suits you before you trade. Okay, so I hope this video has helped you understand commodities a little bit better. Thank you for watching.